Hi, guys. Thanks for joining us today. Today, we're going to talk about how to define the exit. You guys are welcome to ask questions as we go along. And when we finish, we'll go around the room and people can talk about what they're doing and how they're working in this space as well. So with that, if there are no more questions, let's go ahead and kick off. My name is Hall Martin. I'm the CEO of Ting Capital, and we help startups and investors connect for funding. And today we're going to talk about how to define the exit. One of the reasons investors are slow to invest in startups is that the exit is typically undefined. We only know when we might get a return back when the company sells or goes public or does something else. And so what we're trying to do here is show that you can define the exit. And if you do, you can actually make the funding process go a lot faster because investors are going to be wanting to come in to be a part of it because there's some definition of an exit in there. And so the first thing I always like to bring up is, there's two ways of calculating a return. One is ROI, return on investment, and the other is IRR, internal rate of return. ROI is return on investment without respect to time, and internal rate of return is return on investment with respect to time. More sophisticated investors typically use IRR because they're taking in the time value of money. So if we go to the next slide, we'll look at an example here where what you can do is if you had a 50K investment in 2019 and you got 150K back 3 years later, that's a internal rate of return of 44%, and the return on investment is 3x. If you have 3x investment coming back in 5 years, a 50K investment in 2019 would give you 150 back in 2024. It's still a return on investment of 3x. 50 in, 150 out is a 3x. It doesn't matter when that happens. But the IRR in this case, because it took longer, is no longer 44%. It's now 25%. So you get a lesser return. And many investors look hard at that IRR or that time frame in order to make a decision about making investments. The faster money comes back, the better the return. So if we go to the next slide, what we will talk about is the investors all want a 40x return, and once in a while a great equity exit comes along. But until then, there's many companies that fail to reach the exit point. They shut down, and but at the same time, many companies are successful. They're just not 40x successful. So the challenge for the investor is finding that 1 in 10 deal, or with this process, you redefine the game and invest in the 9 out of 10 that are successful and structure the returns to get a return out of it. And so the idea here is to not just bank on the 40x return or the 10x plus return, but set it up so you can actually find a return on any deal that doesn't go bankrupt. So if we go to the next slide. And so the way you do this is, you define the exit is start with a term sheet that puts a redemption right into the deal. This puts some definition into the term sheet for how you can provide an investor a time frame on when they could get money back. And if the CEO goes on the payroll exit, and this is what happens in a lot of deals, they go up a ways, but they decide after a few years it's not going to be a big payout return with selling the business. The market's changed, the competition's changed, the technology's changed. There's many reasons. We saw many companies that were well on the way to a great exit find that COVID changed their dynamics dramatically, and there's no longer a big exit there. And so the idea is the company, the team of the company have the option of going on the payroll exit, which means they just increase the salary and they just stay in the business longer, and then they have an exit. But what happens to the investor in that case? And this is what worries the investor, is how do they get a return out of this when the company has decided, well, we're really not going to have a big exit anymore. And that happens more often than you think, and we'll look at that here in a moment. But the idea is in a 3x and 3 deal structure, you get 3 extra money back at year 3, or you start getting it back then, or you commit to the equity track. And this is the fear that most people have when they do revenue-based funding is, well, what if this is the next Facebook and I'm in here just taking a piece of the revenue? I really want equity. And so what this does is gives them the optionality of either going on the equity track or the payroll track, but you get to make that choice 3 years from now rather than today. You'll see investors freeze up trying to analyze that situation a lot because they're trying to figure out which way this is going to go. But I guarantee you 3 years from now, that decision will be a lot clearer, a lot easier to make when you get to it. So if we go to the next slide. So basically a 3X and 3 basically refers to a convertible note with a redemption right at year 3. And it's at investor's sole discretion. So the investor has control over it. Every investor makes their own choice. And it's a 3X payout over 6 to 12 months and is usually not in one paycheck. It just depends upon what the investor decides to do. If they take all 3X out and you've escrowed the principal, well, then you can probably pay it off in about a year using a revenue share agreement. Investors have control over all cash disbursements in the event the company cannot pay. So there's some choice about making sure that a payment plan is set up. If they can pay their own salary, they can pay the investor too as a view of the investor. And this gives a 44% IRR on their funds. So this is a very compelling investment thesis for the investor. You'll find many investors signing up for this. So if we go to the next slide, these are the terms that we can put into it. And then the redemption strategies, many investors I find they want their principal back when the time is up. And that way they're playing with house money after that. So you see a lot of interest in that. So I always recommend to startups escrow money to pay back the principal. And then the rest goes on a revenue share agreement. I find that tends to be the way that's easily negotiated in many ways. And place a third of the shares into a cash redemption, recover the initial investment, third into the company as an equity stake, and a third as a cash redemption to place into a new startup as well. So some investors will take out the 3X, but they'll want 1X to make their fund whole, 1X to invest in the company itself. So really they're only taking out 2X in this case, and they're going to start filling out more startups. We see this with people that are growing an entrepreneur ecosystem, accelerators, incubators, et cetera, do this. They're trying to make their fund evergreen. They want some money back because they're going to put it into the next startup to build that local entrepreneur community, and you'll see a lot of it. The other strategy I see people take is, well, they're just going to take half in debt and leave the other half for equity. And depending upon how negotiable you want to be, you can negotiate different variations on this situation rather than making it all of one or all of the other. And I find that many startups are in a place where they're happy to take half in equity and move that over to the equity cap table, and the other half they'll do on a rev share agreement. So you want to think about what your situation is and make clear to them what would help you when we get to this point, because investors will be looking to figure out what's a good deal for the business. And you'll find that in many cases, if they're getting their principal back, they're very, very negotiable on the rest of it. They may all put it all into equity if they think there's going to be a good return coming out at that point. So let's go to the next slide. So, the payback plans are, if you can pay all of it back in one go, you can, you're done. If you can't pay it all back, well, then you're just taking a piece of the revenue. Typically, this is 1, 2, 3% of the top line revenue. It's usually not much more than that. And you pay back until the money is gone. It's top line, not bottom line. So you have to think about that coming off your margin as well. Some startups I find are actually at a point where they want to sell the business and move on to the next thing. And that's not a bad choice. There's sites out there like Micro Acquire that you can go look to see what is the going rate for the kind of business I'm selling, and you can see what people are offering to sell their business at. Yes, in the news you can hear about $4 billion sales, but we're at a different level here, and there are sites that will show you what businesses go for, and you see what you can get there if you want to pay the investor off and move on to the next thing as well. And then sometimes I find the CEO or the follow-on investors will pay off the debt and take them off the cap table, especially if you're going to Series A, Series B funding, or Series C funding. They want to clean up the cap table, and some of the money will go to take out the old investors because they want them out. And one thing is great is many of these guys, they've already set what their price is. You don't have to negotiate, that's their price. And you can easily take them out at that point and have the money back. Say about 30% of the entrepreneurs I work with on this topic are really, really hoping the investors take their money and leave because they want the equity back. They think in the long haul, they'll want that money will that equity be worth more to them than what they're paying out right now. Just depends upon your situation. Another choice is some companies can declare a dividend and you dividend that to the investors, which is not a top line, but there's a bottom line to it that some people will buy into as well. You may have to offer them more for it, but you at the same time, you could choose to do something like that. So there's lots of options here on how you manage the investors when they get to that stage of it. Let's go to the next one. So at this point, let's go around the room, and if there's any questions, just let us know. You can show your video and introduce yourself, tell us what you're doing and so forth. And if you have questions about it, feel free to pose them and see what we can go. Who would like to go first? Reagan Rodriguez, you want to go first, Reagan?
Yeah, my only question is, I know my experience has been that someone that is maybe not an accredited investor, the chances of them investing are a lot faster. And usually when you deal with a very sophisticated, savvy investor, they're going to naturally have more questions since this is not their first rodeo. So what advice would you give to all of us? Because there's a difference between if you talk to someone that doesn't have as much money and they're thinking, gosh, this could make me rich, versus that person that's already wealthy and is looking at this a little bit more carefully.
With the more sophisticated investors, what they're trying to figure out is how to mitigate the risks. I think you're right. Many first-time investors really don't see the risk; they just see all of the opportunities. But those who have invested before have probably lost money, and then they have concerns. What if the team doesn't perform? What if the market changes? What if, and the list just goes on. And so what you want to do is try to surface what risks they see in the deal and then show how you mitigate it. One thing this 3X and 3 does is it gives them an out. It gives them a floor, so to speak. And that gives them a lot of confidence that they can say, well, if the market changes, well, if we don't get to, the competition is stronger than we thought, well, there is a choice of being able to pull out of the deal with 3X instead of none, zero. That's the alternative. And that's one of the challenges. And I find that if you're in the venture capital world, they really want 10X return, because they bake their management fee and their carry fees and so forth into the fundraise. They have to have outsized returns. Nothing like this is going to work with them. But when you're an angel investor, a family office, and you're putting your money into it, wealth preservation is a big factor, and they're the ones that are going to be the most responsive to this because they really want to see their principal come back at the very least, and maybe a little bit of a gain, even if it's not a 10X return. So let's mitigate the risk and show that you're guaranteed your original investment back at some point. And I don't want to get specific because is it 3 year, 4 year, 5 years? It could vary. But in startup investing, people, angels expect to have money back in the 5 to 7 year window and looking for a 3 to 5X return. So, it's a long-term investment, but there is a path to a successful investment versus none. So it's a good question. Others there, Timothy or David, you have any questions, or you want to talk about what you're doing?
Yeah, I have a quick question. In your experience, typically, do you find that later on, if a company does a 3X and 3 redemption at a seed or pre-seed stage, and then they get to a Series A or Series B stage, and then they raise venture capital in the range of 5 to 15 million, do you find that some companies have trouble at that later stage raising that Series A or Series B round when investors notice that there's seed investors on this type of model? Does that cause any friction, or it doesn't really matter?
Well, they're going to want to clean up the cap table. So they're going to want those old investors off the cap table if they can. And I find if it's a 2X to 3x, then it's really not an issue. They'll pay them out their 2x. So if they put in 50K, they'll pay them out 100, and they're off the cap table because they want to clean up the cap table. If they want them on the cap table, then they come in, and what you have to demonstrate to the investors that are already there, this is going to have a very strong return. When people ask me what I do, I always say, well, I'm doing what the company is doing. If you're raising money and your valuation is increasing, I'm on the equity track because that's where everyone else is. And where we get into an issue is when the company comes back to me 3 years later and says, well, I've decided not to raise money. I've decided not to increase the value, and I'm really not sure what the exit is going to be anymore. That's code that they're really going to be just on the payroll exit. And so, like I said, I'm doing what you're doing. I'm on the payroll exit with you. I'll just, take a salary, and, we'll all just do that together. But you're right. When the VCs come in, they're going to want to clean that up, and they will want to buy out those early investors or see them convert to equity at some level. And so it's a negotiation that needs to take place at that point. I think the strength of angel investors and the early stage investors is the timing of their money. But what they don't usually have is they don't have money that can carry their pro rata through. They can't keep going up the curve with $5, $10, $15 million investments. They just don't have the money. And so it's often a better option for them just to take their 3x and be out of there, as opposed to trying to hold on to their position in a growing company. Maybe some later stage family offices can do that, but the vast majority of investors, individual investors, really can't. When the VCs start coming in, that's really a time to start stepping out, because I find the VCs start putting in terms that favor the later investors, not the earlier investors. And I always coach angels, you really don't want to be running around the feet of elephants, because you will get stomped on. They will crush you out at some point with pro rata rights or follow-on rights or full ratchet, whatever. Is going to be hard to keep up with those when they start going to that level. So I think you can incentivize people to take the exit, take the buyout, and take some of the money that you're raising and apply to that. Now, VCs don't want to see a lot of money going to that. They want to see a little bit going to that, but not a lot. But that is a negotiation point that will come up.
Okay.
Timothy, any questions from your side?
No, you just covered quite a few of them, because I think that's, in my experience, that's where this type of strategy will work very well, is with kind of at the angel level, kind of as a bridge towards in between kind of the earlier financing and then being taken out kind of in those further stages, whether it be an A or B round, something like that. So I think you were spot on there. Right. I don't have any other questions. Would just love to introduce myself to Reagan, David, Kennedy. My name's Tim Calise. Work with a group. We are Ninja, NYNJA, and we've taken the last year and a half or so and built an integrated solution, communication solution for small and medium-sized businesses. So whereas a lot of small businesses try to rely upon a patchwork of Zoom and Slack and Dropbox and all these disparate systems, we basically took the best features from a usefulness perspective of all of those and put them all together in one integrated platform. So, and added some kind of really highly desired features which just haven't appeared elsewhere. Things like at the beginning of a meeting, for example, our platform will actually call all the attendees. So it's actually a push rather than a pull. So, you can Google how many memes there are about, what are the dynamics of a Zoom meeting? And they usually start with, where is so-and-so? Can you hear me? I can't see my screen, that whole thing. We've eliminated all of those things. And there's just one example of kind of removing some of the grit and the gears and we're cross-border, instantaneous translation and transcription for voice memos and things like that. So just trying to make the life of a small and medium-sized business, which relies very heavily upon their technology to make it work better for them. So just a pleasure to be here and great to see you guys and great questions. So appreciate it very much.
Great, Timothy. And I think you're right. It's mostly angels that in family offices that are doing this. Like I said before, VCs want 10x plus returns, and they're not messing around with 3x. You're either 10x plus or you're nothing. And so it's one of those issues that it really is going to come down to angels, and angels need to be looking at a 3 to 5 year window, not a 15 to 20 year, because the chance that they'll keep their pro rata over that amount of time, and that's if there's a lot of fundraising going on, is very, very low. You get into clawbacks and you get into other things because I have one of my investors has a saying, a minority shareholder's ownership is determined by whatever the majority shareholders thinks it should be. And down the road, the later stage money is going to determine what that is. And that's usually okay, but not great. And so that's why I always encourage people to take the money and move on out and move on to the next thing. And if at year 3 you can start taking out the money, you can get a very decent internal rate of return. It's when you wait 10 years and get 3x that it's not quite as great as we thought it was going to be. And that's one thing to emphasize, is you can start to exit sooner rather than later. I've been to many of Angel Conference, and I can tell you the number one challenge they all face is, how do I get out of this deal? I've been in here for 10 years. How do I get out? And when I propose this to people and they really understand it, they get really excited about it. So when you go to someone and say, are you interested in a 3x and 3? They're not going to understand what that is. When you explain it to them, you're going to find they're going to be very interested. So it's something you have to kind of walk through, because it's something that's not that standard out there. But at the same time, we're seeing a lot of new deal structures come up. There's something called SEAL, SEAL. And basically, it's a salary earnings agreement, and it's basically an income share is what it is, based on how much compensation the team takes, or how much profit it takes. They'll take a % of that as the payback, because they feel like that's alignment with the startup. Because if you want a big salary, they want a big paycheck, and so we'll just take a piece of the salary that comes out, or % relevant to the salary, and that's how they want to do it. And it does a little bit of the same thing we're doing, where if you want to go on the payroll track, well, they're already on the payroll track. They're already taking a % out. And in that case, they're doing it in reverse. They're just assuming they're going to be on the 3X plan, so to speak, but they're going to have the option to switch to an equity agreement later if they want to. So you'll find that there's a number of tools out there that are trying to accomplish the same thing, which is stay aligned between the investor and the entrepreneur as you go through changes in the business. Because over a 3-5 year window, a lot of things change. The product changes, the team changes, the market changes. There's just a lot of things that happen. So what we're considering today is going to need to be able to manage the situation we end up in tomorrow itself. We're near the end of our time, but we have a few more minutes. Are there any other questions people have at this point? Cool. Okay. Well, next step is, appreciate you guys coming today. We'll work to move forward with more 3X and 3 projects we have coming up. We are moving a lot of our events into Clubhouse. I know David came to one we had last time. We have another one this Thursday with Peter Layton. Peter is an angel investor from the Hyde Park Angels. He comes out. He knows quite a few family offices as well as angels. Love to have him come out and talk, or he'd love to have you come out and talk with him about your deal, get some feedback. Was this a good fit for Hyde Park? How would they perceive it? How do you position it? I always like to ask investors what that looks like, get some feedback from him on that. If you're after family offices, he's introduced me to a number of them. He's actually based in Wisconsin now, so he's drawn the circle wider into other areas where they have quite a few family offices. So he's a great connector. He knows a lot of people. He'll make a lot of introductions, and we always like to return the favor for that. But the idea is he asked him to come out and talk to people about Hyde Park Angels in Chicago to see what kind of deals they look for, what kind of questions they ask. And you can tell them a little bit about your deal, and then afterwards he can make some introductions and maybe look at a pitch in a more detailed way. But it's a great way to expand the circle and start getting into some of these other groups. And Clubhouse is a great format. It's no slides. It's just stepping up to the stage, talking audio, very light, very easy, very conversational. So it's a great way. We'll do these every Thursday at 5 o'clock. And this week we have Peter Layton. Next week we have Drew Tolkien of the New Mexico Angels, who will do the same thing. And then we have a number of other that are lining up, like Robin Hood, which is a angel group out of Pennsylvania. So like I say, you'll see us doing a lot more of these events to come and meet investors and talk to them about your deal. Any other questions before we wrap it up for today?
No, I think you answered everything. Thank you, Hall.
All right, guys. Well,
Yep.
thanks so much for coming, and look forward to seeing you at the next one, and appreciate your taking time.